Hi, this is Phil Greenwood, and in this podcast, we want to talk about what I think is always one of the most driving questions for craft brewers, especially ones that are growing like crazy, trying to provide some formula or mechanism to help us determine how much money we need to help finance our growth. When we talk about funding needs, companies can seek it basically from two sources. Outside the company from banks, investors, venture capital firms, and such. Or we can try to figure out how we can generate profits, more profits, keep more profits in the business, or manage our cash flow better. When we talk about methods to estimate financing needs, we're primarily talking about two different ways. One is called the AFN method, which we'll address today. The additional funds needed method, which will give us a very rough formula using our balance sheet, income statement, and our next year projection to give us a rough estimate of how much money we need. And then in the next series, we'll get more into pro forma projections, where we'll talk about mechanisms to finance, do financial projections, and then estimate cash flow needs off of that. Relating it back, where we're really talking about when we talk about these financing needs is, remember, it's really dependent upon the stage that your business is in. At the top of this slide, you can see that, the development stage, which is really where you got your idea, putting your plan together. You're just trying to seek a little bit of money to help seed the business, usually coming from your own pocket or family and friends. You're too small. You don't have any collateral for a bank to loan to. And you want to get enough money to get things up and running to get you through that startup stage where you've formed either the LLC or C Corp, starting to buy some equipment, and you want to develop some initial financial statements that you can then go obtain some startup financing to get you to the survival stage, where you begin to have enough business to kind of get the company up and running, get the brand out there, and all of a sudden you're starting to see that, my gosh, we've got customers, we're starting to grow like crazy. Now we've got to do a projection of cash needs and really seek some serious first-round financing to get us to that rapid growth stage. The rapid growth stage is what this really addresses, is companies all of a sudden hit that S-curve where they've been very small and all of a sudden sales really take off. And this is where a lot of companies fall into trouble, is they don't seek enough money to help them finance their growth, both short-term and long-term. So when we look at financing, probably the biggest thing we want to do is try to estimate our sustainable sales growth rates. In other words, how much can we grow from internally generated funds? When we're talking about internally generated funds, we're usually talking about managing our accounts payable or accounts accrued liabilities, or the amount of profits that we retain in the business. So we're going to have to try to estimate what our net income or profits after taxes will be both currently and in the future, and try to estimate how much we can keep in the business to help finance that growth. And to do that, we're going to have to determine what's our sustainable sales growth rate that we can fund from those internally generated funds. And the sustainable sales growth rate is the rate at which we can grow sales that we don't have to seek outside financing. When we say the rate that we can grow sales is what percentage can we increase it without having to go to the bank for more money or go to outside investors. Well, many times we face that growth curve where we don't have enough internally generated money, and we don't see the internally growth funds increasing enough to fund our expanded growth. So we have to estimate additional funds. What we want to do is estimate our additional funds needed. AFN, we call it. What that is, it's the gap between the total capital we're going to need versus minus the stuff that can be spontaneously generated from putting off paying our vendors or maybe extending our accrued liabilities, and the internally generated profits that are retained in the business. Or what we're really talking about is estimating the total amount of assets we'll need over the next year, 5 years, subtracting out the spontaneously generated funds from our liabilities that we can manage a little better or extend a little better, and the increase we can keep of profits we can keep in the business, which will give us our additional funds that we need to go outside the company for. So here's one simple example. Look at a company that's generating sales of $20 million in the current year, projected to grow by 10% to 22 million. The profit levels, the current year is 10% or 2 million. That's going to stay the same in our projection. Down below, you can see a rough estimate of we have the current year's assets and liability and equity. This company, we have total assets of 30 million in the last year. That's funded by short-term and long-term debt. Those will be our total liabilities of 16 million, but also funded by our common stock of 4 million and 10 million. And you can see in the next column, we calculate those numbers relative to sales, so we have a percentage. And so when we want to forecast, when we look at our forecast, we not only want to forecast our sales and potential profits for next year, but we also want to estimate what do we think our assets, liabilities, and equities will be in addition to that. So if we look into the future and we forecast that we want to keep our percentages of our assets and liabilities the same, you can see that our short-term debt will have to increase by 1 million. Our long-term debt will have to increase by 600,000 in order that their levels in relation to sales maintain the same. But at this point in time, we're not going to be seeking any additional common stock, because that's one of the things we want to try to estimate is what amount of common stock will we need in order to maintain that 10% sales growth. So in this business, we grow sales next year by 10%. We're going to estimate we're going to keep 50% of our profits in the business. So we think that we'll be able to grow, our net profit will be 2.2 million next year. We'll be able to retain 50% or 1.1 million. That will increase our retained earnings from 10 to 11.1 million. So that gives us a sense of, okay, this is what our balance sheet will look like in addition to our forecasted profits. Will we need any additional money going forward? That's where AFN comes in handy. AFN is a simple but a kind of a long-winded calculation. And what it's trying to do is determine what will our external funds amount be needed in order to maintain this growth. So in the formula, what you're doing is you're taking your current year assets divided by your current year sales to estimate a relationship of assets to sales. You multiply that by the change in sales that we forecast. In other words, we expect sales to grow by 10%, or in dollar amounts, we expect sales to increase by 2 million. So to maintain that same assets to sales ratio, we go 1.5 by our $2 million increase in sales. We're going to need approximately $3 million in additional funds, in total funds or financial capital, in order to meet those needs. Well, partial of that is going to be funded by what we call the spontaneously generated funds, the liabilities to sales. If you recall, our liabilities were 16 million in the example. So we're going to take our 16 million divided by the short-term debt and long-term debt, the 16 million divided by last year's sales times the increase in sales, or 80% times the $2 million increase in sales. So 3 million of that funding needed will be financed by 1.6 million of additional money coming from our liabilities. Now, additionally, we can try to provide funding from our increase in how much we increase our retained profits from the forecasted increase in income. Remember that our increase in profits, that we for every dollar of profits, we keep 50% in the business or retained earnings. So we can estimate that at the profit margin is 10% times next year's sales of 22 million. That means that we'll have net income of 2.2 million. 50% will be retained in the business. So we'll be able to keep in the business 1.1 million. If we add that to the 1.6 million that we're going to get from our added spontaneously generated funds, that means we'll have, of the 3 million needed in total capital, 2.7 million will be financed from both retained earnings and also our spontaneously generated liabilities. So we're only going to need $300,000. Now, what does that mean from a standpoint of in relation to our finance. Remember, we said we want to grow our sales by 10%. Well, let's look at this table here to kind of put this in relation to what we're really looking at. If we had said we just wanted to grow sales, we didn't want to grow sales at all, and we maintained sales at 20 million and the same level of profitability and only kept 50% of our profits in the business, well, because we're not growing our sales, we don't need any additional capital to fund our increase in assets. So that $1 million in retained earnings would basically be increased cash flow. What happens if we wanted to grow our sales by 5%? Well, we'd need to increase our assets by 1.5 million. Our retained earnings would have to increase by our retained earnings would increase by 1,050. We'd still have an excess of $350,000 in cash beyond what we need for our business. Now, you can see the middle number there, 7.7%. If we were going to grow our sales by 7.7%, we'd need 2.3 million in assets. Well, if we increase our with the 7.7% increase in sales, that would have generated 1.077 million in retained earnings, plus the amount that we would generate from our spontaneously generated funds. We would not need any additional financing. We'd be able to finance our growth in sales solely from the retained profits and solely from the internally generated, spontaneously generated liabilities. That 7.7% is what we call the sustainable growth rate. So that if we just grew our business 7.7%, we wouldn't need any external capital. When we grow above that, if we want to grow higher than 7.7% next year, we're going to need additional money. We used in our example 10%. If we want to grow sales by 10%, you can see that we needed $300,000 in additional financing needed. So we'd have to go out and seek, we'd need equity financing of that amount. Now, what if we thought sales were going to grow by 20%? Well, if sales were going to grow by 20% next year, we'd need $6 million. We'd need $6 million in total financing to fund our assets. We'd only get 1.2 million out of our retained earnings, and an additional amount from spontaneously generated liabilities. We need an estimated 1.6 million in external capital, mainly in equity. So what we're trying to show here is that using the simple AFN formula, it can give us a rough estimate if we can maintain those same ratios of liabilities to assets, sales to assets and such, and profit retention ratio. It can give us a rough estimate of how much we have to seek in external financing based upon our sales growth rate.